Savita Subramanian, the head of U.S. Equity Strategy at Bank of America Merrill Lynch. Thanks for joining us.
Thanks for having me.
So we've seen the S&P 500 up only 3% so far this year, and it's been trading in this pretty narrow trading range. Do you see that trend continuing? Where do you see stocks going for the rest of the year?
So, we have a constructive call on equities. So this year we're expecting the S&P to end the year at 2,200. Which is, a few percentage points away from where we are today. But as you said, it's been a fairly lackluster year relative to the great bull market years we've seen over the past couple of years so far. Our market call this year is still bullish, but it's a lower forecast than what we've expected since 2011. And the reason there is two things. One, we're in a 7-year stretch for this bull market. It feels a little long in the tooth. And two, not surprisingly, valuations aren't as attractive as they were a couple of years ago. We don't think that market valuations are a reason to sell, but they're no longer a reason to buy stocks.
All right, but do you think part of the lackluster return stems from all this focus on the Federal Reserve? I mean, is the Fed a distraction to markets? Wouldn't it be great to get back to an earnings-driven equity market?
It would be great to get back to a fundamental market, and we haven't had that. You're right, we haven't had that since 2009. It's been all about policy responses to slowing growth, which is one reason that I think this year, if we get a Fed tightening, and we're expecting this to happen in September, that could actually be the best confidence booster to global markets. And really what that suggests is that all of this QE that we've pumped into the system, this $4.5 trillion, actually worked, reinvigorated the economy, and we're back to a more normal cycle where rates are coming off of zero and growth is actually broadening out over a wider variety of areas. So that I think would actually be a very bullish sign for risk assets if the Fed is able to actually lift off of a zero base.
All right, and you also say high quality stocks tend to do better than low quality stocks during times of high volatility, yet some of these riskier low quality stocks trade at a higher premium. So how do you balance those two factors, and what should investors be owning right now?
Well, we like high quality, and I think high quality is not just the theme for the next year, but it's a theme for the next decade. And here's the story. So low quality companies, very cyclical, volatile companies with lots of leverage, have done pretty well for the last 30 years now, and they've grown fairly expensive because capital has grown cheaper and cheaper and cheaper. So in a world where interest rates have fallen from 8% down to zero, that's great for low quality companies that can finance their growth at a very low base. But going forward, if we're in the process of unwinding all of this liquidity, we think that companies that have healthy balance sheets have enough capital to fund their own growth, i.e. lots of cash on balance sheets. That's going to be the way to generate better returns.
And are there certain sectors that have these high quality stocks?
Yes, so our favorite sectors, technology, industrials, and energy. The bigger cap companies within each of these sectors have cleaned up their balance sheets. They've taken off a lot of their leverage, and they're hoarding a significant amount of capital, which they're starting to return to shareholders through dividends or buybacks. We think those are areas of the market that could thrive. Strategic acquisitions, cash acquisitions have been rewarded, and larger companies are actually buying growth in smaller caps. So those are areas that we really like in this type of environment where we're finally starting to unwind the liquidity that the Fed has created.
But you also see a lot of risk in consumer discretionary stocks.
That's right. So the one sector where we are underweight that is cyclical is consumer discretionary. And the reason here is consumer stocks tend to do really well in an early cycle economy. When the Fed is easing, they're trying to stimulate borrowing. But the minute you see the Fed start tightening, we've noticed that over the last 3 cycles, consumer discretionary stocks have underperformed the market. So these are the retailers, the restaurants, the hotels, companies where spending is actually stymied by higher rates because it costs a little bit more to borrow, and consumers are actually incented to save rather than spend.
Savita Subramanian, thanks very much for your time.
Thank you. Thanks for having me.